Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. I'm delighted to be joined today by our Chief Investment Officer, Richard Champion, who is going to help us cut through all the noise in the markets, demystify what's happening, and hopefully help you feel more informed, confident, and in control of your financial future. So if you can grab your coffee, let's dive on in and see what was going on. So last week gave us, I think we would call it a classic market twist with great economic news, but falling markets. So I really want to understand what's going on, Richard, if you can help us understand that, when strength suddenly becomes a problem.
Well, last week, US equities, which have been leading this amazing rally we've seen since the ceasefire in the Gulf War, fell about 2.5% to 3%, particularly on Friday, which is a very weak day. And that was because on Friday, there was a monthly jobs report published in the States, which showed stronger jobs growth than had been expected.
Okay.
And that has reignited inflation worries and caused markets to reconsider whether we're going to see rate cuts this year at all, and whether, in fact, we may instead see increases in interest rates during the rest of 2026.
So that's all driven by the risk of inflation continuing.
Correct. So we've had a bit of a bump up in inflation, largely driven by the energy price going up following the war with Iran, but also seeming to have a few more knock-on effects. We are seeing an enormous amount of spending on AI.
Yeah, we talked about that a lot last week.
We've spoken about that in a number of these podcasts, to the extent that at the moment, at the current sort of rate we think that spending is going on, it's adding about 4.6% to US GDP in terms of that spend, which is a really big stimulus at the same time as we've got other stimuluses going on from the US government. So all of that means, as we've spoken about before, the US economy is probably running a bit hot.
Yeah. Okay, so labour market resilience, jobs going up. I think manufacturing strength is on a 4-year high as well, isn't it?
Correct.
In the US?
So surveys of manufacturing have shown, again, really strong numbers, and prices paid elements of those surveys have also been strong, which increases that worry about future inflation.
And so all in all, the consumer's still holding up.
Correct.
So all very positive statements. So why has that impacted the markets? Why have they gone down if all that's positive backdrop? Just all about inflation.
So it's really common for good economic news to become bad market news. The market is discounting the future. So when it sees good economic news, it starts to worry about interest rates going up to control inflation. When interest rates go up, what's called the discount rate, that's the amount you discount future earnings by, also goes up, which means that number becomes less. When you've got a low discount rate, your future earnings are higher in value today. When you've got a higher discount rate, they're lower. So as that goes up, people reevaluate what valuation they're prepared to put on the market. And what we had on Friday last week was a classic example of people reevaluating the highest valued parts of the market. Interestingly, we saw some of the lower valued parts of the market hold up perfectly well. But now that AI is such a large part of the US market, the overall impact was negative on the wider market.
So the lower discount, did you say? The
lower valued sectors
the lower valued
held
sectors.
Up because they're less prone to the squeeze in valuations down from the very high levels of some of the AI names.
What are those? What would be those lower value sectors?
Healthcare and consumer staples would be great examples of those sectors. Yeah.
So it wasn't really a bad week then, after all. It was just a bit more of a reality check.
Absolutely. I think a reality check is a really good way of putting it. We have had 9 extraordinarily strong weeks, driven, as I say, by the technology complex. We've seen gains in some cases of 60 or 70% over that period. So giving a little bit of that back is entirely healthy. It allows a little bit of uncertainty to go into market valuations. We love the saying, we're climbing a wall of worry. And here is a bit of the worry that we're climbing at the moment.
Okay. Got it. I think we also talked about the new Fed chairman, Kevin Walsh, coming in. And I guess this might impact the policy decisions that he's going to make going forward. So what do you think is happening there?
So Kevin Walsh is in a quite difficult position.
Yeah.
He's been appointed by Donald Trump, who wants him to cut interest rates almost irrespective of what the economy is doing.
Yeah.
But historically, Kevin Walsh has been quite hawkish. He's been quite keen on being early to raise interest rates. He's made a lot of the idea that the burgeoning use of AI will help boost productivity, and better productivity is very good because it allows you to grow faster without having inflationary impacts. But it appears at the moment the weight of money going into AI, plus what's going on in Iran and the Persian Gulf, is making his job very difficult.
Yeah.
And so it's going to be very interesting to see, having been appointed by Trump as his man who's going to get rates down, he may well turn around and actually be a bit more hawkish, which would be a surprise from a few weeks ago, certainly.
So I always have to say hawkish, rates flying high.
Correct.
Yeah. Okay. And dovish, going down.
Yep.
Okay. So I did actually quite like the President Trump quote in this week's Weekly Markets Review. I thought it was a view that many people would intuitively share. And he said, with a great jobs report just like announced, stocks should go up, not down. That's the way it was for 200 years. Growth does not mean inflation. How else can a country attain greatness? I thought it was quite an interesting quote.
Yes, I think that President Trump is being a little bit disingenuous.
Did you think?
I think so. Perhaps. I'm being very, very tactful. It's well-known market aphorism that good economic news is bad for markets. And on the obverse of that, bad economic news is good for markets, because the markets looking forward say we're going to get either higher rates, bad for markets, or lower rates, good for markets.
Yeah, okay. And actually, some lower rates if you've got a big mortgage to pay.
Helps the economy, exactly.
Helps the economy in different ways, doesn't it? Okay, interesting. So I think it's short and sweet this week. Maybe we're on a little double espresso with extra sugar rather than a flat white than the coffee break this week. So I think I will sum up by saying after 9 weeks of gains, this pause is healthy but not alarming. Rates are staying higher for longer. That's still plausible.
Correct.
Resilient growth is still a positive backdrop. So this isn't about a weak economy. It's about a strong one just adjusting to slightly tighter conditions.
Correct. And just to be clear, we're talking about the US specifically, rather than the wider world economy.
Do you want to touch on the wider world economy?
Why not? I mean, the wider world economy continues to be pretty weak, in fact, but the inflationary impacts we're seeing may mean that the European Central Bank, for example, this week raises rates because of it seeing the inflationary impact coming from the war in Iran. But that's going to be raising rates into a weak environment, which isn't a great place to be.
No.
Everyone's focused on the US where the economy is much stronger.
And it's such a big market.
It is a huge market.
Yeah. So strong economies don't always lift markets, it seems, especially when inflation is still in the room.
Correct.
Okay. Thank you very much. And thank you for listening to the Canaccord Coffee Break podcast. I hope you've enjoyed it. Don't forget to follow on your preferred podcast channel of choice, and you will never miss an episode. And as always, we'd love to hear your thoughts. Do drop us a line, ask any questions. The email address is coffeebreak@canaccord.com. Thank you very much.
Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.